All right, everybody, we're going to start the webinar now. First of all, thanks for dialing in on a Tuesday afternoon. Welcome to the Mid-Columbia in 2014 Hydro Outlook webinar. My name is Chris Jilka, and with me is my colleague Dennis Lucy, and we both work on the West Power Desk here at Genscape in Boston. So first of all, everybody attending the webinar will get a copy of these slides emailed to you. And also, if you have a question during the webinar, just type it into that box in the lower right part of your screen, and we'll get to it at the end of the presentation. So on the agenda for today, I'll do a brief product summary. I'll go over the Mid-Columbia Trading Hub, what it is, Pacific Northwest Hydro System, the fundamental components behind it. We'll go into hydro, take a look back at what happened last year. We'll go into some forecasts. We'll do some supply analysis. We'll introduce our Pacific Northwest hydro forecast. And then at the end, Dennis is going to do a walkthrough of Genscape's new wet term service. So a little bit about the product summary. My team here in Boston have been working on this West Term product or service for the last 6 or 7 months. And just a real brief summary of it, the components of it are you would get an IM blast at 8:15 in the morning summarizing market-moving fundamentals and periodically our trading recommendations or areas that we see risk. And that would be on the left side of your screen, that would be the text box. And you can also access archived commentary through that as well. You get daily, hourly, monthly, quarterly power price and heat rate forecasts for 9 different hubs, heavy load, light load, and flat pricing. You get thematic brief reports. You get webinars such as this one, summarizing our seasonal views, key risks. Sometimes we highlight market and regulatory uncertainties. We did a webinar on AB 32 a couple years ago. And then you get a daily, weekly, or email or IM, a personalized call every day. On the website, you get tools. You can really quickly visualize comparisons of our price forecast to current forward prices, which Dennis will highlight later. All of the forecasts are archived back to 45 days, so you can track our performance on a daily basis. And then you get access to our meteorological staff via phone call or IM. You also get a bunch of historical time series data inside the website. You get intertie flows, CAISO historic outages, NRC nuke outages, fuel prices, temps. And then lastly, you can run custom sensitivities based on your own inputs, which we'll highlight later on. So what is MID-C? MID-C stands for the Columbia River. It's basically a trading hub or a scheduling point that represents the physical interconnection between Chelan County PUDs and Grant PUDs hydroelectric projects. And there are some attributes that make Mid-C hub a little bit different than other hubs in the U.S. Hydro and renewables are the fundamental drivers. Pacific Northwest has added over 2.2 gigawatts of wind in the last 2 years. The price is typically not indexed to any LMP, but to a volume-weighted index such as ICE, Argus, or Dow Jones. It's a winter peaking system, usually peaks in December and January. It has limited export capability. There's usually excess supply, especially in the spring, and the system is capacity or export capacity constrained. And it is one of the most liquid and volatile swap markets in the country. And if you see this little table down at the bottom, this is a summary of ICE trading. The source is from EIA, and it's 2013 day-ahead trading. And you can see average daily volume for Mid-C was 63,543 megawatt hours, which is way above the other hubs. And the number of daily trades was 125 versus 46. And these are all day-ahead markets, but it just shows you it's there's deep liquidity, at least in the dailies for Mid-C. This is another way to look at Mid-C. This is a schematic or diagram of Mid-C. On the left, you have Chelan PUD's control area and Grant on the bottom. and then the 4 dams that are associated with it. And the arrow shows you where they are in terms of Pacific Northwest and the Columbia River Basin. So the Columbia River Basin is highlighted in green, and you'll see that it does extend into Canada. It's very large. It's larger than the area of France, so it's around 260,000 square miles. Canada contains about 15% of the basin, but contributes around 35% of the average annual flow at the Dalles, and it's the highest hydropower producing region or river in the U.S. And I'm going to mention the Dalles throughout this presentation. And the Dalles is a reference point for all these different dams. The Dalles is really, it's the second to last dam before the Columbia drains into the Pacific. And it's an area where they set flood control levels to, and a lot of the water, or most of the water from the whole basin flows through the Dalles. So that will be our point of reference throughout this presentation. So in talking about relative volatility, these are the implied heat rates at a bunch of different Western trading points. These are on-peak heat rates from 2012 to 2013. The mid-sea heat rate is the red solid line down below, and you can see it trades as a discount to the other hubs, but it is a lot more volatile. And if you look at June 2012, you can see that the heat rate can go from 2.5 to 10 in a matter of weeks. The off-peak heat rate is not depicted here, but it's even more volatile, as with the increase in wind capacity, it can capture the supply stack shifts from the least expensive coal generator primarily to the renewable resource. The price can shift from $8 or $10 to zero in a day. So here's some graphics of stream flow volatility and demonstration of the lack of storage that makes this hydro system unique. On the left, once again, we're talking about the Dalles. This is 70 years of water year runoff, October through September. And for example, you can see the average is around 135, but the range can be from 70 up to 190. And then if you want to look at a recent example from 2010 to 2011, annual flow is up over 50%. On the chart to the right, we're highlighting the ratio of average annual runoff to usable reservoir storage. So you can contrast the Columbia with the other river systems of the Colorado River and the Missouri, and you can see that the average annual runoff is multiples of how much can be stored on the system, which is the inverse of other rivers in the U.S. And that green bar depicts around 135 million acre feet, which is an average to above average year. I mean, we've seen it up to upwards of 180, 190. So a lot of flow and not much storage. So this slide is really a key to understanding the fundamentals behind mid-sea. You have to think of it as a series of rivers and dams throughout the whole region that's owned by a very diverse group of stakeholders. But the key is it's managed as one system to meet the needs of the entire region, or at least that is what the aim is. The stakeholders are BC Hydro, Bonneville Power Administration, otherwise known as BPA, the U.S. Corps of Engineers, NOAA, the states of Washington, Oregon, Montana, and Idaho, various investor-owned utilities, and even tribal interests. So the point of the slide here is that it's not managed just for power production. It's really managed for other mandates. More important than power is flood control and environmental factors, and at times of the year, irrigation, recreation, and navigation all play out, and you try to forecast hydro flows. So on the picture to the right, if you start with the green dashed line, that is, once again, we're looking at flow at the Dalles. We're looking at a 70-year average, and you can see that if there was no dams, the natural flow peaks out in June at over 450 kcfs, and then when you start to regulate that for flood control, power, and irrigation, that flattens the curve. And then when you add in biological opinion or fish regulations, it shifts the curve even more. So the three arrows indicate, you see how it shifts the curve down in the winter and then up in the spring. And that means it really means a shift of several gigawatts of generation that are robbed from the winter and fall when load is high and pushed out to the spring and summer where load is light. So it's evidence that the system is really not managed for power. So behind this are really three main agreements or treaties. And these are the drivers of the regulated flow, and they are super complex and interrelated. I could spend a whole webinar. I probably would run out of time to just do one of these, so I'll go over them really quickly. The Columbia River Treaty started in 1964. That came about in a flood of 1948, which flooded BC into Oregon, really bad flood, 50 deaths, millions and millions of dollars of damage, and it's an agreement between Canada and U.S. And what it basically does is provide storage in Canada as a protection against flooding down in Portland or in the U.S. And to reciprocate, the U.S. helped to pay for those dams and does return some power throughout the year. The PNCA, or the Pacific Northwest Coordinating Agreement, it's really an outgrowth of the CRT Treaty, and that binds everybody south of the border, the BPA, the IOUs, the non-federal entities on the U.S. side to coordinate with the BC interests. And that optimizes all the diverse elements on the U.S. side. The PNCA really drives a lot of what happens. It has very important data submittals from all the different entities that happen yearly, monthly, weekly, and those can really change the natural flow forecast. And the third one is BIOP, or biological opinion, started in 1995, and that's the system operation was just dramatically altered to increase protection for salmon in accordance with the Endangered Species Act. And there's a lot of examples of this, but the two main ones I can think of are, in the spring, all the dams on the Snake are giving yearly spill requirements, and that aids the passing of migrating salmon. In the winter, they hold back flows below the Bonneville Dam, which is the very last dam before it flows into the Pacific, when the salmon lay their eggs, and it basically keeps them at a level where they are not dewatered during a lower flow that could happen afterwards. So now we're going to get into hydro. We'll start with a little bit of a look back. Those of you out there, I know a lot of you are in the Pacific Northwest, know that 2012-2013 hydro season, Pacific Northwest and southern BC were generally wet, especially in BC, except for the Snake, which ran a little bit below normal. In this slide, figure A and C represent seasonal outlook. So in the previous season, October through December, A, which is the first slide, was quite wet from Northern California into Washington and most Idaho. And that's in contrast with the most recent period where both Pacific Northwest and California have been really pretty dry. The lower slides, slides B and D, is when you isolate just January. And you can look at California by itself, and you can see how much drier it is this year. And to speak more on that, the drought has been really bad in California. Things have changed slightly this week. And we put together most of this webinar at the end of last week. They've gotten a lot of precip in a short time, but our meteorologists on staff say it would take several storms of this sort of anomalous magnitude to get us to a normal state. And to get away from Pacific Northwest, and since we're talking about Cali Hydro, we also analyzed the CAISO markets as well. The continued dry look raises some risks for the summer. Some of them that we thought of were forest fire-related congestion. The CAISO has a history of dealing with that. You could get an upward risk in CO2 pricing because of the increased call on gas resources. And then you could have some real-time spikes or ancillary service scarcity due to lack of hydro, which could be exacerbated by the recent solar build-out, which I'll talk about in a little bit. So talking about like an update, we put this slide in really just these last couple of days because so much has changed. February is is off to a pretty good start, with most of the Pacific Northwest seeing normal to actually at the end of this week. Some of it could be above normal, and that's boosting snow levels in parts of BC, Idaho, and Montana. Dennis will speak to this later on. But the Cascades still remain below normal. And this is an excerpt from our actual website this morning, outlining we do precipitation forecasts for the 6 to 10 day and 11-15 outlook. So we basically have 3 to 7 inches equivalent landing in the Cascades, and up to 3 inches in the interior Pac Northwest. And this will continue out into the 6 to 10, where we still think you can accumulate in a lot of the Columbia Basin. And it could go out even farther. We should get a series of disturbances which will post those snow water equivalent values. So pushing forward into March from a meteorological point of view, we expect modest improvement in the drought, given this favorable pattern for mountain snow. And we do expect colder temps in the Pacific Northwest. The drought, I'll reiterate that the drought is so severe in California that although we've added quite a bit, there's a chance that things could get severe this summer. And we want to look at our forecast relative to NOAA. The spring months are expected to favor above normal temps for the southern Pac Northwest into California and the Great Basin. This is consistent with a neutral ENSO forecast. There's really not much of a sway as far as ENSO goes. The takeaway would be some maybe upside demand risk in the desert Southwest and parts of California. So now looking at supply, so our hydro forecast, which is the thicker green line from our model, tracks pretty close to the 7-year average from March through mid-May. And then around mid-May, it starts to break away from the 7-year average, and it starts heading towards that lower red line. And the lower red line is actual 2001 BPA flows. We do a lot of analysis around BPA because it's an aggregation. It's a good benchmark. So you can see how low 2001 is. And the interesting thing is the dotted black line is actual BPA forecast. So you can see we're currently tracking sort of where 2001 is, and that's kind of close to our forecast as well. So now getting into like some of the sensitivities that we're able to run. So Dennis and I, on the 28th of January, a couple weeks ago, we came up with the idea of taking the very worst scenario. So we cobbled together BPA actual flows from the 2001 hydro year, which was the second driest in like 54 years. Heavy load, mid-sea heat rate. On that day, the heat rate was trading on the price of the heat rate, and our forecast that day was below 7,000 for a heat rate, and that's depicted by the green dotted line on the bottom. So 2001 flows, extreme dryness on the top, and then our forecast from the 28th on the bottom. And what this depicts, basically, it's a sensitivity analysis, and it shows you that there is potentially more downside risk, or at least that's what our model was showing at that time. And the blue solid line is where the heat rate has traded the last couple weeks. You can't forget about wind. That's definitely something to factor in. This slide just tells you that wind has a 30 to 40% capacity factor through April and through June, which is the strongest output levels of the year. I don't think we'll have to worry about it too much this year, but in the big years of 11 and 12, you can get some extreme negative pricing in May and June when the wind blows strong. So if you look at throughout WEC and where the capacity additions are for this 2014 year, solar is the thing that jumps out the most. So the current solar capacity, installed capacity, we believe it to be around 3,900. And that's because we've seen, and that's capacity, we've seen it actually hit 3,100 the last couple of weeks. So if you take the recognized January capacity factors, we believe that's installed capacity now. Looking at the ISO chart to the right, which aggregates solar thermal and solar PV, we think by the end of 2014, installed capacity will be 5,500 to 6,000. And then we think that towards the end of the spring, early summer, you could see peak generation, it's not capacity, but peak generation values of around 4 gigs. So quite a bit. This is really what's changing the most in terms of you know, capacity additions and technology. Which brings us to the infamous duck curve, and we're going to work this into our mid-C analysis. So the duck curve it depicts, this is from the ISO, you can search on the internet and find many different examples of it. It is a typical March day, and it shows the potential for net load in the years 2013 to 2020. And what it's showing is what that increase in renewable generation, variable generation will do. And I'll have to say net load is your demand minus solar minus wind. So in the spring, the CAISO, and this is going out, you know, our assumptions going forward, the CAISO may become more reliant on imports from the Pacific Northwest to help dispatch around the evening ramp. And the evening ramp is really the neck of the duck. And you can see the lower that net load goes, the longer it has to go to get up to the neck or the beak. So it's, we think in the spring they could potentially source more from the Pacific Northwest. In the summer, they could be less reliant on imports from the Pacific Northwest in the peak, as your max solar gen usually peaks in early afternoon. And then I threw in this graph down below, which I thought was interesting because that is this is CAISO net load from yesterday, and the red line is it's demand, real-time demand. The green line is net load, and then the black dashed line is the SP15 real-time price. And you can see it does somewhat resemble a duck, and we haven't even got into 2014 or 15. And the takeaway from that is, you know, we're seeing, you know, $10 prices, you know, $10, $20 prices in the belly, and then up in the neck or head of the duck, we're seeing $85 amount. So yesterday was a day of low demand, high solar, high wind. So just wanted to point that out, that the duck is coming sooner than you'd think. So with that, I'm going to turn it over to my colleague Dennis. Thanks.
Thanks, Chris. So I'll kind of walk you through the current Genscape WEC term reports and what we have to offer here. I'll just do this through kind of a series of screenshots of our website that sort of tie into the story that Chris has painted for what we're expecting here in spring. So as Chris mentioned, you know, our full website you know, does provide a lot of information, you know, from the end of the game pricing to a lot of the inputs that go into our models to come up with those prices. And it also includes a lot of access to historical data for WEC and CAISO, gen outages, temperatures, et cetera. So just kind of looking at this one, this is, you know, a shot of our landing page in our WEC term reports. It's a price summary screen. As Chris mentioned, we do price forecasting for 9 hubs in WEC, including mid-C, which is featured as our first, it's first in the list here. And we do a 1-year forecast. So we are currently forecasting prices all the way out through December 2014. And just to kind of touch on, you know, some of the comparisons between us and the market, we do compare ourselves against marks provided by EOX Live. They do gather pricing data, and they're a sister company of the brokers Equus and Choice. So they are coming out with price data, you know, based on actual, you know, broker information. So the prices that we're comparing ourselves to are very similar to what you would get on ICE. And just looking at our forecast for May and June, as you can see, you know, Chris mentioned that we were below the market for June back in late January. We're still below the market for May and June right now. We're about $5 cheaper in May and about $9 cheaper in June. And a lot of that goes to, if we had to guess why, we think it's because of where we think or where we're seeing hydro generation being come the spring runoff season versus where we think the market, what the market might be seeing. So let's talk a little about our hydro. As Chris mentioned, the hydro generation is a very key factor in the Pacific Northwest. It accounts for, especially in the spring runoff season, the bulk of the generation in that area. And our reports do include an entire section on renewables, including a lot of data on forecasting hydro flows. So for our long-term hydro forecasting, we're utilizing SNOTEL data from the USDA Natural Resources Conservation Service. And we build upon the known relationships between snow water equivalents and how that translates into future hydro flow. So for those of you not as familiar with the Mid-Sea, you may wonder, what is a SNOTEL? Simply put, it's a sensor that's remotely placed in the mountains that gathers meteorological data about the site, including snow water equivalent, which is another way of saying, what's the amount of liquid in a given spot if we were to take the snow there and melt it down. So for hydro forecasting, we tend to think of snow as an energy storage system. It's something that builds up over the course of the winter, and then during the spring melt, gets converted to water, it flows into streams, then runs through the hydroelectric dams and produces power. So our hydro generation model is utilizing data from somewhere around 600 different SNOTELs, and we're using what we call a nearest neighbor approach. So we take the SNOTEL readings and we kind of look where we are in the hydro season. Our model is going to go out and grab the 5 closest years to where we are, look at the actual flow patterns, how flows progressed over the course of the spring, and then construct an average. And it's that average that we use to determine how much power is going to be produced in the Pacific Northwest. So where are our current SNOTEL readings? There's a lot of attention's been paid in the media about how we're experiencing a very dry situation in the West, particularly in California. And I think that's been punctuated by the drought declaration by the governor of California the last couple of weeks. So here in this shot, again, this is a screenshot from our website. I sorted the river basins in the Pacific Northwest from highest to lowest by the SWE equivalent, the snow water equivalent. And if you look at the bottom of the list, there are some very low snow totals down there in the Willamette Valley and some of the Oregon closed basins. The snow levels in those areas are running 20% or lower than what you would expect in a normal year. If we move a little further up the chart, you'll see entries for the lower Columbia, the middle Columbia, and the upper Columbia, and they're running about half of normal. So far I've painted a dire picture, but what we're seeing is, as you make your way up to the top of the chart, some very interesting basins are showing pretty normal snowfall, snow totals. Things like the Snake headwaters, the Clearwater, which flows into the Snake, and I know we've talked a lot about the Columbia, but the Snake is also a very important river basin in terms of hydroelectric power. And then third on the list is the Pend Oreille, which winds its way up into Canada and then dumps into the Columbia, before we start talking about Grand Coulee and really the bulk of the generation on the Columbia River. So for a lot of key basins, we're doing pretty well. And I guess just to go back what Chris said about our forecast for the rest of the month, we are expecting rain and snow throughout the Pacific Northwest in a pretty decent amount to the extent of our forecasting ability, through the end of February. So it's, we believe that these snow percentages are only going to get better. All right, so let's translate that into some actual dispatch. This is a screenshot of a dispatch report for Mid-C. Here we show the monthly dispatch of the load and then the generation at Mid-C for February through June. We are a winter peaking system when it comes to load, and you can see that borne out in those load totals. Average load, we think is going to run somewhere around 27.5 gigs this month, and that's going to come off about 3 gigs by the time we get to June. We also see hydro generation increase, and in fact, by the time you get to June, you can see that hydrogen is almost going to be able to meet the low requirements of Mid-C by itself. You throw in wind, and you almost have all of it covered there. In the off-peak, which I don't show here, wind and hydro tend to, they can more than cover load, which can actually lead to thermal generation being completely displaced out of the stack. So if you look at a strong runoff year, we have seen things like off-peak pricing around $0. That does make it pretty interesting there. I'll show you one last slide here from our reports. This is our dispatch flow, and it shows how flow power is moving from one region of WEC to another. Where I want to draw your attention to in the chart on the left, we see two very big red arrows, both emanating from Mid-C, one bound for NP15, one bound for SP15. And on the right, I put what our forecast interface loads are. And if you look at the top row, Mid-C into NP15, you'll see that the forecast loading for the on-peak hours of June is very close to the max rating of that interface. And then near the bottom, you'll see Mid-C into SP15. And again, it's a very similar picture. And again, this represents the abundance of hydropower in Mid-C, and that power being flowed into California. So, we are predicting that those interfaces are going to be pretty close to capacity all month. So it's very possible that some power could get trapped in Mid-C, which could lead to weaker pricing in Mid-C as we're forecasting. Again, that just kind of shows you some of the capabilities of our reports and how it ties into a lot of what Chris said. And so that hopefully gives you an idea of what we're looking at for spring in Mid-C. So without any further ado, we'll now take any questions that you may have. Again, please submit them through the little interface, the GoToMeeting interface that you have there, and we'll start reading these off and working through them.
All right, we've got a whole bunch of questions rolling in. The first one, what does your CAISO hydro forecast look like relative to last year's actual?
So this one's a little tricky, and it kind of gets away from Mid-C, but it is a very important topic given everything that's going on in the West. The extent of California's drought conditions have really made it a bit hard to forecast hydro generation, since we really don't have a good analog for what we're experiencing. As Chris mentioned, Northern California did get quite a bit of rain and snow over the weekend, but the fact remains that we're in a pretty dire drought situation there. So we did do some forecasting for hydrogen, and right now, just to kind of put in perspective, last year was a pretty weak year. Right now, we're seeing May and June running about 200 to 400 megawatts weaker statewide than last year.
Great. So we got a whole bunch coming in. One of them is, are there any other teleconnections besides ENSO, which is the El Nino Southern Oscillation, that have an impact on hydro in the Pacific Northwest? I think one of the slides had indicated that we're in a neutral ENSO state, but there are a couple teleconnections that do have influence. I know that the PDO, if it happens, I think it has a proven effect on the yearly salmon runs, which sounds kind of funny, but that will affect the fish counts at certain locations over the year, which can then impact the environmental flow for that year in terms of fish spill and whatnot. Let's see. Another one is, what percentage of total generation, Pacific Northwest hydro generation is represented by BPA? And Dennis, I think, is it around 60%?
Somewhere around there, yes.
Yeah, we have to double check on that. I think that's close. Another question is, how do we handle WEC outages? I'm assuming they mean generation outages. We do a couple of things. We use a combination of many different sources. IIR, we have a partnership with IIR, so we overlay our forward curve with IIR outages. We collect all the data from the CAISO 515 report, which is a snapshot of curtailed and operational plants every day, and we look at archive data from that. We look at, of course, NRC outages, and then lastly, we do monitor a pretty high amount of generation in the Pacific Northwest, and we have data going back 9 years, so we actually build our own forward outage curves from the proprietary Genscape specific plant data. Another question, an easy one, what is GS? That is Genscape, I think, from one of the slides. What else do we have, Dennis?
Here. Someone asked what gas pricing point we're using to calculate heat rates in mid-sea, and I know this is quite a contentious topic.
But a good question.
It is a very good question. In our calculations, we're going with SUMAS for gas. I know, some people tell you there's the Malin versus SUMAS debate, but we're using SUMAS in calculating our heat rates.
Another question is, the new CAISO node Willow Beach going to be forecasted in the future? This is our WEC term product, so we forecast zonal prices with this model methodology. We have another service which does Balde and Next Day CAISO, which is a little bit more granular, and we started to do more real-time and day-ahead nodal analysis, so that will be in our model, Willow. But for this product and what we're talking about here, that won't have an impact. Why did you use a forecast 7 years forecast to benchmark our forecast? And the reason for that is what we had for data.
So those are actuals. It was
Yeah.
the previous 7 years of actuals.
Right.
And we used that, so it's a 7-year average against our forecast.
Right, and we actually talked to BPA themselves, and we couldn't get anything. We had trouble getting older archive data. Does the Alberta power market factor into your mid-sea price forecasts? It would, in terms of interchange between BC. I think that's about it for topical questions. Well, I want to thank everybody for joining us, and have a great day.